All right, hello everyone. Welcome to another edition of my video on Forex trading. Wow. Before I continue this video, I would just want you to please subscribe to these channels because what you're about to see is something that will change your life forever because it's actually changed my life. So I'll make it very, very short because it's a whole very long video. And so I want to make it as short as possible. So I want you to subscribe to this channel because I'll be covering let's look at the content of the candlestick anatomy, candlestick patterns, the market structure, time frames, and top-down analysis. All this you don't want to miss. But I can only cover these three on this video right now, just these three over here. These three here, 1, 2, and then parts of market structure, but not completely market structure. All right, let's dive in. Okay, now talking about candlestick anatomy. Now it has to do with the formation of candlestick. Okay, the formation, how does it form? Okay, this is the high, this is the close, and this is the open, and this is the low. If you're a beginner trader, this is good, useful information for you. And if you are a pro, well, I'm sure you know all these, but there are parts of this video which you don't want to miss. Quickly, this is a bullish candlestick formation, and it means that it opened right here, and then this is the lowest point it drove to, and then eventually went up, came back to this opening price, and when it came up here to the high price and closed here. And this is a bearish candlestick pattern which opened right here and came to this highest point here. After some times, the sellers came into the market and drove the price so down to the lowest point and closed here. Very easy. That's the anatomy. Now, candlestick patterns are formed based on the time frame that you trade, depending on the time frame. Okay, if you're trading on 1 minute time frame, if you put your chart on 5 minutes time frame, like I said, this is the anatomy. Okay, so we'll quickly go straight to the pattern itself. Anatomy means how it is formed. A lot of you might not know if you are trading on a daily chart, because as soon as you are a full trader now, you understand what I mean by time frame. Time frame is the time in which each candlestick is formed to take your trade. Now, let me quickly move to the next. I will be showing you now. Before I move to the candlestick pattern, I want to talk a little bit about body sizes. The body size of a candlestick really matter a lot. It does matter. This is the reason why candlestick size it talked about or expresses psychologically it expresses the momentum that either the seller or the buyers are driving the market with. If you see a candlestick pattern, a bullish candlestick formation as big as this, it means that the sellers are so much around there. And if it's very small, it shows a small influence of the buyers. Why this one shows the influences of the sellers. Quickly, now, part of the anatomy, you'll be wondering that what is this long shadow doing? And this long wig here, it's very easy. This is it. Now, it means that this candlestick, this is a bearish candlestick, okay? It means that this candlestick opened right here. And for one reason or the other, the bulls came in and drove it down to this point. When they came and drove it to this point, I'm sure it would be very full. And for another reason or the other, the sellers came back to the market and drove the price down. So this means rejection of price. They drove it down to the place and it closed here. It closed here. And then this other week also shows the lowest point in which this candlestick got to. Same has to do with this particular candlestick pattern. It opened here, and for one reason or the other, it opened here. For one reason or the other, the sellers pushed the price downward to this point, and the buyers came into the market probably because of some forces of demand and supply or support level. The price came up here, and it looks as if the buyers will continue up. Eventually, the sellers pushed the price a little bit down, and it closed here. That is why you're having these wicks here. Now let's quickly go to the candlestick pattern. So I'll be sharing with you 15 candlestick patterns. There are other candlestick patterns that I had to remove from this point, from this video. I will be sharing it in other of my videos. But these 15 candlestick patterns, if you can master them, you'll be very good in trading, in doing your trading. If you are a synthetic trader, you are a currency Forex trader, you are a cryptocurrency trader, this will really help you. This candlestick pattern will help you when to enter a trade, when not to enter a trade, when to exit a trade, and when not to exit a trade. So 15 stick, the first one I'll be sharing with you is the engulfing candlestick pattern. This is a bearish engulfing candlestick pattern, and it simply means the bears are always represented by the sellers. The sellers are always called the bears, all right, because the market is about buyers and sellers fighting, the bulls and the bears fighting. So the bulls are refers to the buyers, while the bears are refers to the sellers. So as you can see quickly here, this black candlestick pattern refers to the bearish candlestick. That means in an uptrend, if the market is going up and these patterns occur, you take your trade, that the trade will go down. As you can see right here, this is an uptrend. This is a bearish engulfing candlestick pattern. You place your trade at the close of this candlestick and then take your profit at the next key level. Take your profit at the next key level. Next is the bullish engulfing candlestick, just the opposite of the bearish. The bulls engulfs the bears. As you can see, the bears are represented by this tiny candlestick. Like I told you, the momentum is dropping, and then there's a formation of a big bullish candlestick at the end of a downtrend or a support level. Note that the bulls are about coming into the market. Like you see this example here, this is a downtrend and this is a support level around here. So as soon as this market, as soon as this candle closes here, you enter your trade, put your stop loss below the formation of the candlestick pattern and take your profit towards the end. Next is the doji. The doji is an indecision candlestick pattern. The doji is simply going to occur either at the resistance level or at the support level. So when you see a doji, a very practical doji like this at the support level or a downtrend, it means the market is about to reverse to the upside. And if you see it in an uptrend, it means the market is about to reverse to the downside. So anywhere you see a doji, it means a reversal pattern. See an example here. This is a doji. The market was trending up, and this shows also a drop in momentum. Enter your trade at the close of this doji and then take your profit at the next key level. Target your profit at the next key level. Next is there are two types of doji. We have the dragonfly and the gravestone. Let me talk about the dragonfly. The dragonfly doji is this formation like this. Okay, you know the doji is around this place, while the dragonfly is always top. It's a bullish reversal pattern. Look at the formation right here. You see, it's a bullish reversal pattern. These occur at a support key level. When this formation is formed, enter your trade and take your profit at the next key level. You can see this is a doji. While the next is the gravestone. It's an inverted doji, sorry. The gravestone, as you can see the gravestone right here. Okay, so let me go back. So that is the gravestone. The gravestone looks like this. The doji was here, while the gravestone looks like this. So it's a bearish reversal pattern. This occurs at the end of an uptrend. Okay, look at an example here. As you can see, an uptrend. But mind you, don't forget I said these patterns must occur at key levels. So I am a very careful trader. So I trade at key levels. You don't just jump into trade and pick a random trade. You have to wait for market to return to the key level. When the structure is broken, you wait for a retest, or you wait for it to go back to the key level. Like this is going to a key level. And when you get to a key level, you notice when you look to the right, how do you identify a key level? When you look to the right, you discover that anytime market gets to this range, this region here, it's always reversed downward. So you watch for a formation of a candlestick pattern for you to enter your trade. Don't just enter your trade because the market has hit the level. All right, next is the morning star. I love this pattern because it occurs so much. I'm going to show you examples in the live chart soon. Don't worry. So we have the morning star. The morning star has to do with the bullish candlestick pattern. The morning star is a three formation candlestick pattern, which includes the the first candlestick is always a bearish candlestick, followed by either a bullish or a small, but it has to be a very small candlestick. It could be a bullish candlestick or a bearish candlestick. But mind you, the third candlestick pattern must be a bullish candlestick for it to be identified as the morning star. So this morning star is always occurring at the support level or the end of a downtrend. As you can see, the end of a downtrend. See, downtrend, the morning star, and then you have what? You have your uptrend. So how do you trade this? You wait for this candlestick formation to close up, and then you enter your trade here. Okay, you might be afraid that this candlestick formed close at bullish formation, but eventually it went up. So don't be deceived. Just be sure of your entry. That's all. Next is the evening star. The opposite of morning star is the evening star. The evening star is the first candlestick is always the bullish candlestick, followed by a small candlestick. It could be the bullish or a small bearish candlestick. But mind you, this third candlestick must be bigger than the second candlestick, or it must be a bearish candlestick for it to be seen as the evening star. And this candlestick pattern is always occurring at mostly resistance level or the key level. Now look at it. The market is going to the upside, and when it forms this candlestick, it came down to the sheet. Sorry about that. Now, the next is called the pin bars. The pin bars, we have two types of pin bars. We have the hammer and the shooting star, or the inverted hammer. But let's talk about the pin bars, which is the hammer. Okay, this means rejection of price. Most times, this always occur at when the trend is trending down. So this big, remember I told you that the candlestick here, the long wick here is showing rejection by the buyers. It means that the buyers are about to invade the market. It was formerly coming down to this place. It came down here, but eventually the buyers came into the market, and the market eventually closed here. It shows a sign that the buyers are about to come into the market in a downtrend or a support level. As you can see in this example right here, the market was trending downward, and this candlestick formed. See that? Next is the bearish pin bar. The bearish pin bar. Next is the bearish pin bar, or you can call it the shooting star. The shooting star is simply a bearish reversal pattern in an uptrend where the trend is trading up to the moon. When it gets to a key level, you watch what pattern comes up. As soon as you see this pattern, you know that the market was actually, this candlestick was actually trading up. But one way or the other, the sellers came in and pushed the price to this place, and the market closes here. It means that the buyers regime is over, and then the sellers are about to come into the market. Look at this trend here. It was trending powerfully up, and then this pin bar came up, and suddenly the market dragged down. Mind you, I said enter your trade at the close of this candlestick here, and then take your profit at the next key levels. Next is the Arami pattern. Arami in Japanese language means pregnant mother. Okay, so this is the mother, and this is the small baby. This is called the bullish Arami pattern. Bullish Arami pattern in the sense that in a downtrend, where the market is trending so down, and then the Arami pattern formed at the support level, it means that the bulls are about to come into the market. Mind you, the first candlestick pattern is a bearish candlestick pattern, very big, and then pregnant with a baby candlestick, which happens to be the bullish candlestick. So this pattern, I love to trade this pattern so much because it gives me confirmation. Sometimes I trade this pattern as it is. Sometimes I trade it when another candlestick formation forms here. Imagine if the candlestick formation that forms next is a bullish candlestick, it means it's a confirmation to me that the market is about to trend upward if it was trending downward. Why? Because if I have a bullish big candlestick or a bigger than this a little bit, it means I have automatically formed the morning star. See that? So this bearish, this Arami pattern can give birth to the morning star or the evening star. Look at this, for example. Sorry, okay, let me quickly explain the Arami pattern, the second Arami pattern, which is the bearish Arami pattern. This is always the mother. The bull candlestick is the mother, while the bearish candlestick is the baby. It occurs mostly at the key level, which is known as the resistance level. It means that the market was trending up. Now it's about to go downward because of this baby here. Now look at this example showing the two patterns. You can see this is the bullish Arami pattern. It means that when the market trend downward, it shows this pattern and immediately it came up. This was what I was talking about. This pattern that formed here is this candlestick confirmed that this is a morning star, and it's a very strong signal to tell you that this market is going to go up. Same with this one too. Same with this, as you can see, this is a bullish candlestick with a small candlestick. Normally, ordinarily, this is a bullish Arami pattern, so I can just enter the trade. So a bearish Arami pattern by trading, at the close of this, I can enter my trade here, okay, sniper entry, and put my take profit here. But if I want to be very sure as a confirmed trader, I will wait for another candlestick to form. If it happens to be a bullish candlestick, a bearish candlestick, it has formed to me that this is an evening star. Then I will rather open my trade here instead of this place and short the market. All right. Next is the tweezer bottom or tweezer top. This is the tweezer bottom. This occurs at the bottom of a downtrend. It shows a bullish reversal. You can see here, okay? See here, you can see now this is a tweezer bottom, okay? It's going up after the formation of this candlestick. When you see these two candlestick formation, it means that the market is about to reverse to the upside. So like I told you, make sure you open your trade at the close of this candlestick pattern and take your profit at the next key level. Please, if you have not subscribed, don't hesitate, subscribe. My contents are first class. And I want you to click the like button for you to recommend this video for someone else to see. And please don't forget to turn up the notification bell. And I appreciate your comments so much. I really need your comments. I want you to ask me questions. If you did not understand a particular concept, I will be coming up to do more video on that. Tell me the videos you want me to do, and I will do that video. This is the tweezer top. It occurs at the resistance level or at the end of an uptrend. So when you see this occur, make sure you take your trade, open your trade at the end of this candlestick, and then take your profit at the next key level. As you can see, okay, there was not much example there for that, but I'm going to show you in a real life chart. Next candlestick is called the 3-line strike candlestick. As you can see, this line, 3-line strike candlestick, it's a continuation pattern. Sometimes it could be a reversal pattern. If this occur at a support level, obviously it's going to be a reversal pattern. But if it occurs in between the trend, it's a continuation pattern. Same with this. If this occur at a resistance level, it's a reversal pattern. But if this occur at the middle, it means it's a reversal, it's a continuation pattern. Let's see an example here. Okay, this is a 3-line strike, okay? So you are meant to enter here, put your stop loss here, because this happens to be a support level and it was a downtrend, okay? So it wasn't now a continuation pattern, rather it's a reversal pattern. So after these 3 lines, 1, 2, 3, you will notice it by a very sharp bearish candlestick. You think the market is about to continue downward, but the market reversed upward. So enter your trade here and put your stop loss here in case the market goes against you. Look at this one. This is the reverse opposite of that. It's a continuation. It was going up, and these 3 lines happened, and this candlestick formed here. Now, in this case, this is a continuation pattern. Why? Because this was a bearish, tiny 3 candlesticks. and then a bullish big candlestick occur to mean it's about to continue to the upside as well. So in this case, this three line strike is a continuation patterns. Like you can see, this is also a continue. This in this case now, this three line strike is a reversal pattern. Take note of the difference. At support level, it's a reversal pattern. At resistance level, it's a reversal pattern. But at these key levels, you will notice if it is an uptrend, it will give you three candlesticks that are bullish. And then the next long candlestick that will almost cover the three candlestick will be bearish. It means it is a reversal pattern. Look at this now. Okay, the next candlestick pattern now is called the three white soldiers and the black crow. This is the three white soldiers. It's a bullish reversal pattern. And why this one is the three black crows. Okay, as you can see, this is an example of the three black crows. Like you see, in an uptrend, you have the three black crows, 1, 2, 3. Enter your trade at the close of this last one, and then put your stop loss here in case the markets will continue up. However, when you see three consecutive candlestick formation in this form, the market is about to come down. Okay, remember I told you about the bullish engulfing. Like you can see at the key level here, remember you're taking your profit here, you wait for whatever behavior candlestick formed here. Look at what happened. A very big engulfing candlestick pattern, engulfing this whole of this bearish candlestick. It means that you can take your place your trade here, put your stop loss here, and you know that the market will go up, as you can see here. Next is another example on the three black crows. 1, 2, 3. After this, take your profit. It means now it's reversing. Okay, at key level, it formed 1, 2, 3, and it reversed to the downside. More examples on the three black crows here. Okay, then the three white soldiers. It happens mostly at the support level or the end of a downtrend. 1, 2, 3. So enter your trade and look at a doji is formed again. The doji means a reversal pattern. So you can even leave this doji to form for confirmation, but you can enter your trade at the close of this guy here, and then you see your market go up to the upside. See more examples right here. So these are candlestick patterns exercise that you can do before you move further. Try and test your knowledge on candlesticks. So next is the market structure. Market structure has to do with, looks like this. Market structure is when you have a low, you have a high, then a lower high, and then a lower high, and then a higher high, a lower high, and then a higher high, lower high, higher high. So this is a structure, okay? So talking about structure, this structure here, this is a structure. Let me get my tools to show you. Okay, this is a structure. We're talking about market structure. This is a structure. Now, I discovered that the market came back here before it reversed. So coming to test the structure, and it broke the structure. So from here, this is a low which broke this structure to this place. Okay, it broke this structure to this place, and it has to come back to this form. This is another structure right here, another structure right here. So this structure was broken again. Okay, this structure was broken here. I'm going to talk more on this in a different video entirely, but just understand when you're talking about market structure and market breaking structure, this is exactly what is referred to as market structure. All right, so I'll be stopping here. Like I said, I'll only be covering patterns and anatomy and a few of structure. I will do structure in my next videos. Thank you for watching, and I really want you to subscribe if you have not subscribed. And I'll be dropping the link to my Telegram channels. I'll be putting the most videos link there so that you can go and watch it and improve your trade. It took me a year to also master this trade, although I started this journey in over 2015, since 2015, but I wasn't really too good. So I can't say I am 10 years, 7 years, like other trader we do. I can confidently tell you that within the space of 1 year, I was able to master all these I'm explaining to you. Now I simply have my, okay, now take note of this key level. This key level because when market gets here, it reversed up very strong. This is a daily time frame. So but when market got to this point here, it starts to consolidate, okay? It starts to consolidate. It starts to consolidate, and it formed an evening star. As you can see, this is an evening star. Okay. So after the formation of the evening star, you enter your trade around this place, and then you take your profit almost around this place. Okay, because at this point the market reversed. When it gets to this scale level here, you can put your take profit here. I'm sure it's about to get there. This is daily time frame. All right, so this is another example of the morning star. You can see at key levels when the market formed this morning star. Okay, got you to this point. So you can just cap this. So there are so many examples I can share with you, but I think I'm going to dedicate a video to explaining, to show you live charts on each of those um each of those candlestick patterns. Look at another one here. This is a bearish Arami. You can see a very big bullish candlestick and then a small candlestick to show the baby. So at the close of this, you can do what? You can enter your trade right here, and then you see the candlestick. So I'm sure this was the patterns that drove this crash down of this synthetic. After this, the markets crashed so down and it's still going down to the shade. So many you can, if you look at this chart so much, you see a lot of patterns appearing. So you need this to really enter your trade. Like I told you, they always occur at key levels. They always occur at key level. Let me show you. This is a key level. You see, this is a key level because when price got here, it reversed down. So when it got here, if you look towards your left, you see this is a key level right here. See that? This is a key level. Now, you see this level here, it means, see, this is a very consolidating, a very powerful key level. When price always gets here, it's always reversed. It's always reversing, okay? And that was why when this price got to this point, it reversed down. But before you can even enter your trade, you must you must get a confirmation. What's this confirmation all about? You must get this confirmation here. All right, so I'll be stopping here for real, like right now. So please don't forget to subscribe and don't forget to turn on your notification bell and click the like buttons